Right, welcome to our first chapter of the Forex Basics, where we're going to be asking the basic questions that you'd expect any beginner to be asking. What is Forex? Why Forex trading? Where do we trade Forex? How do we trade Forex? When do we trade Forex? Those kind of questions. Um, and I'm going to try and make sure the responses are very concise, straight to the point, and explain them with as much simplicity as possible. Some of the examples that we will use will be quite exaggerated, but the point is to illustrate how the market works very, very simply because it's easy to get confused. So let's get it. Right. So what is Forex? This is simply short for foreign exchange market, which is also known as FX. This is the largest financial market in the world, trading over $6 trillion daily. This is a lot of market that's moving in a lot of money that's moving in the markets daily. Currencies are being traded heavily on a daily basis. It's the global market that allows one to trade two currencies against each other. Trading forex can be likened to when we exchange currencies at a bank or bureau de change when we travel. Excuse my pronunciation if I didn't pronounce that bureau well. But what I'm simply trying to say is, in this financial market where we're exchanging currencies, a lot is going on a daily basis. One may ask, how do we get to $6 trillion daily? Now, there's a lot that's happening. Imagine big companies like Amazon, they're worth billions. Imagine the volume of things that they import, the volume of things that they import from one country to the other. They need foreign currency to be buying all of these things. Imagine Apple buying parts from China, the kind of money that they're going to be exchanging for them to purchase Chinese merchandise or parts. It's going to be a lot of money that's going to be traded. So there's a lot of these transactions that are happening between banks, between businesses, individuals. A lot is taking place on a daily basis. So this is what constitutes the large volume of trading that happens on a daily basis. There's also quite a lot of speculation, which is people trying to make money from trading, and this constitutes the larger portion of the trading volume. But we'll talk about this in a moment. So coming back to the example, so you are traveling. You're traveling from the States to the UK. You get to the UK and you've got a dollar. You exchange it for pounds and you get £2. I know this is not the actual rate, but again, it's just to make it easy to understand. You get £2, £2 sterling when you get to the UK. Now, you stay for vacation over for, I don't know, let's say give or take 3 months. And when you decide to return to the USA, you haven't used your £2. So you get to the USA and you decide you want to exchange that £2 for dollars again because you can't use the pounds in the States. And to your surprise, you hear that the rate is no longer 1 to 2 rate. It's now a 2 to 2 rate, meaning your £2 is now worth $2. So in the 3 months that you've been in the UK, you've essentially doubled your money by doing nothing, right? So you've made a quick buck and doubled your money. And this is what traders are loosely trying to achieve on a daily basis. And by that, I don't mean they're trying to double their money every day. No, 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 no. But I'm simply saying um, traders are trying to profit off of those marginal changes that happen in currency values. Okay. So if let's paint another scenario where you knew that every quarter this thing would happen. So it means every 3 months, if you go to the UK and you come back to the States, you'd have doubled your money. What do you think the average human being would do? They would make sure they would get as much money as they can, go to the UK, have a stay, not use it, and then come back and exchange it to double their money because they know the return is almost guaranteed. And the more they can go with to the UK and exchange for pound, the more they can make when they come back to the States. Now, this is a model of how traders are working on a daily basis and what they're trying to do, just that they no longer have to actually go to the UK if they believe that the rate is going to change in such a fashion as highlighted in the example. What they simply need to do now is to be part of the electronic market where these transactions are taking place and buy the pound on this electronic market, hold it for however long they need to hold it, and then sell it off when they believe they've made enough profit. Now, the second thing you need to know is buying a currency of a country can be likened to buying shares of a country. Now, if you've bought shares of a business or you've received shares of a business, or at least if you're familiar with the process, even if you haven't gone through it yourself, I'm sure that one thing that we can all agree is when you buy a share of a business, you do it simply because you believe that in the future, whether near or further off, the business is going to appreciate in value. And for that reason, you're going to buy shares in that business because as the business gains value, your share in the value also appreciates. Your value of the share also appreciates. Sorry. So the price of a currency, it basically reflects the opinion of a market towards the economic, political, and social health of a country. So if a country is in political distress and their economy is in shambles and their social welfare is also in shambles, basically you would expect the currency to lose value. And when the currency loses value, if it is a piece if it represents a share of that country, then if you hold it, you're losing value. And the opposite is also true. When you have a country that's appreciating economically, politically, and socially, among many other factors, um, then your share of that country also appreciates in value and you get to make money. Now, um, let's talk about why we trade forex. This is an easy one. We all know we are here for the money. We may have heard a story of somebody who's our friend who started making money. We may have seen something on social media. We may have watched a movie or whatever it is that brought you here. But the simple answer is we are trading to make money. But there are some reasons as well that one may think of taking trading as a career. Other reasons. Number one, you just need an internet connection and a laptop and Wi-Fi and you can trade from anywhere. Okay, I didn't put in Wi-Fi there, but again, it's invisible. Please pardon my dry jokes. Um, but you get the point. This is a business that you can do from anywhere. As long as you're connected online and you have the skill, um, you can always make money or lose money from anywhere. It's important to stress you can lose money. Now, money can be made in difficult times. This is also true. In great times, you can make money, and in times like again, like I said, of political or social unrest, you can still make money because the market is going down, and you predict that the market will go down, and you can make money. Right? There's a relatively low cost of starting. Now, I understand there are brokers that allow you to even fund $1 into your brokerage account and start trading with $1. $1 probably won't, I mean, change your life. But when you fund your trading account with a significant amount of money and you're well skilled, you can definitely turn that decent amount of money into a large sum of capital. As you look to the right there, you can see Takashi Kotegawa turned $13,600 to $153 million in 8 years, which is crazy. He's a monster trader. You can appreciate that he's got very good and sharpened skill to do so. And this is what a lot of traders are trying to achieve. Hopefully, you understand that this is not something that you need to do as a get rich quick scheme because Forex is not a get rich quick scheme. In as much as you can achieve attractive rates of capital growth, you need to know that it's going to take longer than you think. This is just the reality of Forex. It's never going to meet your deadline. We've all been there. You come into trading and you say, I want to make 1 million in 6 months, and then 6 months comes up, you've not made 1,000. You decide to extend your deadline to a year, and then you end up in the negatives by the end of the year. It's just how Forex is. You need to focus more on the skill. Forex is a legitimate and lucrative business that should be managed like any other venture out there. So you really need to hone in on your skills and make sure you manage it like any other business, like any other career. If you see a doctor who's been practicing for 7 years just to become a general practitioner, you should also appreciate for you to start making money in Forex. You need to be ready to put in time, years even, just like some of these doctors, marketing professionals, accountants, etc. Treat it like a career. Treat it like a career. Trading is risky, therefore, you should go beyond the lifestyle to seek knowledge. That cannot be stressed enough. I think I forgot this point. Beware of scammers. A lot is happening in the industry. People want to invest for you. They offer you crazy returns. Others are selling you trading robots. They tell you this thing is capable of achieving 500% in a week. You know, just stay away from those kind of things. In trading, if just like any other thing, if something sounds too good to be true, you got it. It probably is. Now, how does forex trading work? There are numerous pairs that one can trade. in most cases, beginners start by trading major currencies, and I'll address the part of pairs in a bit. Right. Major currencies are called that because these currencies constitute or represent some of the world's largest economies. This is America with the US dollar, Europe with the euro, Japan with the yen, the New Zealand dollar, the Canadian dollar, the Swiss franc, the British pound sterling, and the Australian dollar. These are all different currencies that can be called major currencies because they constitute or they represent or are a share of some of the world's largest economies. So, for this reason, they're the most heavily traded currencies. Now, when we trade Forex, we trade currencies in pairs, buying one currency and selling the other simultaneously. Now, to help you understand this statement, if you don't, as with the example of when you traveled from the States to the UK, you went to the UK with US dollars and you exchanged your US dollars for pound. Now, this is how you actually trade on the Forex market. For you to buy a particular currency, you need to be selling a particular currency. That's how it happens at a bank or Bureau de change, and that's how it happens electronically on the Forex market. All of these currencies are paired. Now, these pairs are put into three groups or categories. We've got what we call the majors, we've got what we call the crosses, and we've got what we call the exotics. Now, stick with me here. Major pairs are pairs that have the US dollar as one component or one currency, and the second currency is another major currency. For example, the Euro USD pair. It's a major pair because it's got a major currency, which is the euro, and constitutes of the US dollar as well as the second component. That makes it a major pair. So as long as the US dollar is in it, paired with a major currency, we call it a major pair. And I'll explain why it's described major because it's the US dollar in a bit. Right. Then we've got what we call the crosses. Crosses are simply pairs of major currencies that exclude the US dollar. This is, for example, the New Zealand dollar with the Swiss franc. Another example would be the British pound and the Australian dollar. It's a pair of two major currencies, and none of them is a US dollar, right? And then lastly, we've got what we call the exotics. These are pairs that do not have two major currencies or have a minimum of one, and the other is an exotic currency. So an example is the United States dollar and the South African rand. One of the currencies is the US dollar, which is a major currency, but the other is not even a major or a cross. It's actually a exotic currency, like the rand. So as long as you do not have two major currencies in a pair, then you can call that an exotic currency. I hope that's clear for everyone. The dollar rules. So I'm going to explain to you why we say pairs with the US dollar paired with another major currency are the major pairs. Number one, the US dollar constitutes 75% of all trades and approximately 62% of the world's official foreign exchange reserves. Now we're talking investors, businesses, and central banks. The US dollar is favorable for many reasons, among which are the following listed. The USA has commendable political stability. Everybody wants to be holding an instrument or an investment that is stable and not highly volatile, and this is the case with the US dollar. The country is politically stable, and generally because of that, many investors want to preserve their money in the form of US dollars because it doesn't move too violently, or it doesn't swing in value too violently, right? Two, the USA is a military superpower and also the world's largest economy. If they were to face a say political unrest or social unrest, maybe in terms of a situation where there's a war, um, most people would expect the USA to come out or emerge victorious from such a war. And for this reason, if you're going to put money in any other currency, you want to put it with the big guys, the guys who are going to win, and it's unlikely anybody's going to try to poke the bear. it's unlikely that anybody is going to try to start a war with the States. So there's a very little risk of being in a situation where a war could start in the States and the currency could lose value. Third, the US dollar is generally accepted as the main currency for cross-border transactions, right? So globally, because of how big the States is and it being a world's largest economy, when you do international transactions, the fact that each country has its own denomination of currency means we sort of have to look for a way to agree to say, all right, let's peg the value that you're sharing to me or giving me in a currency that is stable that we can both agree to peg that value at. And most cases, this is going to be the US dollar. So for this reason, all major pairs have got the US dollar. There are many other reasons, but we do not need to go through everything for you to get the picture. Right. When can you trade Forex? The FX market, sorry, is a 24/5 industry, meaning you can trade it 24 hours a day, 5 days a week, with exception to weekends, obviously, for days. Now, in as much as you can trade it 24 hours a day, it's not every uh, it's not every time during the 24 hours that the market is booming and busting with big moves. What you want to do is to come into the market during times when the market is making the bigger moves, you know, the relatively bigger moves. You don't want to be stuck in a market where it's not moving. You speculate that large changes are going to be happening and nothing happens for long periods of time. It could just water down your excitement and your enthusiasm to trade. So this is important because now we begin to share with you times when there's a lot of volume and liquidity in the market, terms which I'll explain in a moment, um, so that you can be part of the major moves that take place on a daily, weekly, monthly, yearly basis in the markets. Now, the main trading periods are the Tokyo, Sydney, London, and American sessions. Each session is basically described by the start of the business day in the city that is highlighted. So, if we're going to be talking about the Tokyo session, it's the start of the business day in Tokyo till the end of business day in Tokyo, right? The start of Sydney session as well is start of a business day in Sydney, Australia, straight through the end of business day. The same applies for London, and for America, this would be the New York session. Um, so start of business day in New York till end of business day in New York is normally when you have the markets opening in the States. You will have to adjust your time and learn what time it will be, say, in Tokyo, if you are planning on trading the Tokyo session, but you're not necessarily in Tokyo. You need to know what time it is there. And you need to also accommodate daylight savings changes. So basically, when the time shifts by an hour or whatever it is in daylight savings, you need to make sure you're aware of those changes so that you're in tandem with market open and close. You do not want to be trading when these business hours or trading sessions are not active because there's a lot that happens during those times. Your spreads, oh shoot, I haven't described what a spread is. So I'll share with you guys that information a bit later as to why. But I encourage you to try and make sure you trade during these sessions. Now, these trading sessions account for up to 3/4 of the trading volume. That is your Tokyo, Sydney, London, and New York session. About 43% of all Forex transactions happen in the London session. Because the London session crosses with the other two major trading sessions, and with London being such a key financial center, a large chunk of Forex transactions take place during this time. Now, um, as the Tokyo session is ending, the London session is starting. And before the London session ends, you have the American session starting. So it means during the London session, you can have some of the Asian traders exiting the market, and then later on, some of the American traders entering the market, which means a lot of people are trading at the same time. And this is what we call the liquidity. A lot of traders trading and buying and selling at the same time. That's the best loose definition that I can tell you. So most trends, which is major moves of the market, begin during the London session, and they typically will continue until the beginning of the New York session. And then the New York session itself only constitutes about 17% of Forex transactions. The Asian session then is the third largest Forex trading session. So what you want to do is to come in when a lot of traders are trading, because if the big banks or big players in Forex are making their transactions during the Tokyo, London, and American session, it means that this is the time where you can expect big moves to be taking place, and you want to be a part of those major moves because you're there to profit from the big moves. You don't want to profit from the small moves, you know. So let's move on to the next one. So let's talk about the best times to trade. Ideally, when two sessions overlap, this is the period with the most trading volume, right? The market is likely to make major moves during these periods as opposed to quieter trading periods. I think I've already explained this part. Now let's talk about trading during the week. We've talked about trading during the day. Let's talk about trading during the week. The middle of the week typically shows the most movement as the pip range, or the range in which price moves, widens for most of the major currency pairs during the middle of the week. So Tuesday, Wednesday, and Thursday, these 3 days they typically showcase the largest moves of the week. Now, if you're in London now, you know it's a good time to be trading during the London session. But now you also know that the major moves during the week also take place between Tuesday and Thursday. So you now know good times for you to be looking for those uh, trades that can make you profit in the market. It doesn't necessarily mean you can't trade on Monday and Friday. You can definitely trade on Monday and Friday, but generally speaking, the bigger moves are typically happening on the other 3 days. So here's some trading periods that are not recommended. Sometimes the market can open for you on a Sunday. Ideal not to be trading for reasons I've already explained. Fridays, towards the end of the New York session, it's also bad time to be trading because trading volume simply dies off. Everybody's going out for a break, and you know how Fridays are at your workplace. You know how Fridays are, so you can expect that it's going to be happening for some of the big banks that trade forex and some of the larger parties that make the market move. Holidays as well are not a good time. So there are things like banking holidays, Christmas, Easter, and all those kind of holidays. If you think on such a holiday, a lot of people are going to be home, you probably shouldn't be trading yourself. All right, and then major news events. A typical example would be the elections in the state. When people are waiting the results of those elections and the voting has already taken place, you can expect that the market is going to be moving quite violently because you know everyone has a belief of their own. Others believe the market is going to appreciate in value when Trump becomes a president. Others believe the opposite. And for this reason, a lot of violent moves are going to be taking place, and it's easy to lose your capital. So you do not want to be trading during such periods. Okay. So the last thing you need to know is while it is worth acknowledging that commercial transactions constitute a significant portion of currency trading, most of the 6.6 trillion daily volume is based on speculation. What constitutes most of that trading volume are speculative traders. These are traders who believe that the price is going to go up for one reason or down for another. Majority of the trading volume comes from traders who buy and sell based on short-term price movements. So yes, we did talk about the big corporations that you know effecting large currency exchange transactions. There are also big banks that are doing large transactions. But most of the time, the majority of the volume is coming from the speculators. That's people who are trying to make a buck on the short-term price movements. This therefore means that buying and selling, in brackets liquidity, taking place at any given time is extremely high, right? And this is the crux of how we make money as traders. It's not only you, it's not a simple or a small group of people who are trying to make money by speculation. A lot of people at an institutional down to individual level are speculating on the values of the market of currencies, and this is what's causing the fluctuations of price. So I'm sure we've reached the end now of our session, our first chapter of Forex Basics. I hope you managed to take some notes and learn a few things. In our next chapter, we'll be talking about how to read Forex pairs, how to read Forex prices, and some of the key terminology that you might have heard me use in the first part of this section. It will now be appearing in the second chapter, and I will be explaining a lot of terms. So get a refreshment and come back ready to take some notes and get some definitions. Cheers.